on valuation ratios, can you talk about why, like theoretically, it makes sense they would be related to differences in expected returns? Why are they not useful in timing premiums?
Yeah, that's a great question. I've been thinking about that myself as well. I think, just in general speaking, I do think there is a distinction between identifying changes in expected stock returns over time and differences in expected returns across stocks at any point in time. So essentially, that time series aspect has always been a lot harder than the cross-sectional aspect. I think possibly because there are a lot of changes from time to time, whereas more things can be controlled for when you're looking at the same cross-section at each point in time. But when it comes to valuation ratio, I think you're certainly right? There is a theoretical link, right? Price being the discounted future cash flows. But that also means that, if you see a lower valuation ratio, that can result from higher discount rate, meaning higher expected return, but it can also be due to lower expected future cash flows, or usually a combination of both. So empirically, I think at least in the time series, we see it's not really possible to cleanly isolate that cash flow versus discount rate effects from the data. So that's on the equity side. But actually, good to point out that in contrast, on the fixed income side, the future cash flows are a lot more certain, right? If you're thinking about the promised coupons and par payment. So you can actually say something about the variation of expected returns over time, the variation of the term premiums and credit premiums over time. And that's what we do in our strategies. But that is more like on the equity side. I think because of the noise, you are better off behaving as if the expected premiums are constant. There is another broader point I want to maybe just quickly mention is that there's also a distinction between a statistical relation that you see from the data versus a profitable strategy you're able to run. Because oftentimes you see, regressions, scatter plots showing you some in-sample relation using all the data. But when you run a strategy, you need real-time out-of-sample prediction that's based on only data available to you at that point. So I think that's a much harder hurdle. And also sometimes you see valuation ratios, people say things like CAPE ratio, right? Cyclically adjusted price to earnings ratio, they have been shown to be related to future returns, usually over the long term, right? Over the next 5 years, 10 years, or 20 years. Their interesting thing is that even if you assume there's some long-term return predictability, but then you use it for short-term asset allocation decisions. Oftentimes we see people, right, deciding on allocation on an annual basis. That misalignment in the horizons means that oftentimes you're still not better off. Basically, the precision that's required for you to have a successful timing strategy is nowhere near what we can observe from some of the popular valuation ratios. So I found that pretty interesting from our analysis as well.
Yeah, definitely.
So what are the main implications of this research for pursuing premiums?
Yeah, I think in short, it's time to stop timing, if that makes sense. So in the end, I think premiums, they are positive on average, right? So I think good to keep in mind that whenever you switch out of the market or switch out of these premiums, the odds are already stacked against you. And in recent years, or just over the longer history, we see that the premiums can also turn very quickly, right? So you really need to be there to capture them whenever they show up. But then I also understand, we said at the very earlier, right? It's very tempting to do so. So definitely staying invested will require a lot of discipline. That's why we see, a lot of value from financial advisors to help people stay disciplined. I think one thing I have found useful to point out to people is that just keep in mind that as you're going through those ups and downs in in terms of the volatility of the premiums, the volatility itself should actually give us some comfort for why the expected premiums are positive in the first place. Right? If things just go up every day, you should be worried. And, why are you even being compensated? So to some extent, that willingness to bear that uncertainty and that potential underperformance is rewarded with higher expected returns. Exactly. So I think, so stop timing, but think about other ways to put the odds in your favor. Think about integrating multiple premiums, think about being broadly diversified. These are much more effective ways to put the odds in your favor.
Just on the idea of timing, I tweeted, I don't know, a week ago about how the death of the value premium had been declared in 2021. And then I looked at the value premium from then until April 2024, and it's like, especially in Canada, very, very positive. So staying in your seat is definitely important.
Even equity premium, right? Back in the last decade, probably 2009, people say, "Oh, is the equity dead?"
Right.
Of course, things went different ways. So yeah, definitely. I think there's definitely something to be said about not being carried away by some of the headlines, and then stay disciplined through those ups and downs.
Absolutely.
Can you talk about how important diversification is to capturing the return premiums?
Oh yeah, absolutely. So we're talking about, what are the ways to actually increase your odds, at least improve your odds of capturing the premiums. I would say diversification is very important consideration. Of course, I think people already know that diversification is very useful when it comes to reduce idiosyncratic risks associated with single stock or a country and sector and so on. But our analysis also shows that it can play a very important role in increasing your reliability of capturing those premiums. The reason is that if you just imagine, let's say, give a year, you said value premium was strong in Canada. Let's say, we have a year with a positive value premium, let's say 4%. But if you look at all the different value stocks, it's not the case that all value stocks have outperformed growth benchmark by exactly 4%, right? It's a subset has done really well. They are the ones driving the positive premiums. Some probably had done average and some poorly, right? And the issue is that you cannot really predict which stocks will end up driving that premium. And that subset will also change over time. So that means if you have a more concentrated portfolio, meaning that you kind of just simply sample from the value universe, then you might miss out on the subset that actually drive the premiums. And in contrast, if you have more broadly diversified exposure, and then that will help you to capture the possible premium whenever they occur. And so in our analysis, more concretely, we did analysis. I'm not sure if you have seen that. Basically, we say, let's look at a fully diversified portfolio, right? That's tilted towards size, value, profitability. And then we also look at a few sampled portfolios, meaning that they maintain the same level of tilt to the premium. So basically, you can think about their expected returns being similar, but then they have fewer stocks, right? Maybe 500 or even 50 on average. And then what we show is that the more diversified portfolio will actually give you lower deviation from the market, so lower tracking error for the same level of outperformance. And that leads to a higher probability of outperformance, which is why you see that in our portfolios, we want to be as diversified as possible, given the investment universe and then given our investment goals.
So I really like that paper. I thought that the way that you set it up is really intuitive. But I will say that it's a paper that's been discussed at length in the Rational Reminder community. One of the nerdiest places.
Yeah.
It's at length. There's pages and pages and pages of discussion on it. And the main point of discussion is the fact that you did what you said, which is held expected returns for the different levels of concentration constant. Do you have thoughts on what that analysis would look like if you were increasing expected returns with concentration, like a more diversified portfolio with a lower expected return versus a more concentrated one, but with a higher expected return? Does that make concentration look better?
I see what you're saying. Yeah, I need to check out the debate, and I'm very curious. But it is a very interesting question because ultimately the results, right, in terms of the probability of outperformance, will be driven by two things. One is your expected outperformance, and the other is the uncertainty around that outperformance. Right. So you can think about basically the distribution of your excess return. You have the mean of that distribution, you have the width of that distribution. And to your point, yes, in our analysis, we control for the mean of the distribution. That's basically usually, what we do when it comes to research to say, let's isolate the effect of diversification, right? So that you can show the impact more cleanly. But I understand oftentimes there are also portfolios with different level of tilts, or maybe even for us, right, we have core portfolios with different level of tilts, or maybe even exclude certain parts, say exclude mega caps, so core versus a vector type of portfolio. So then they will come with different expected return. Then there are two effects, right? You are moving the mean to the right, right, more positive, but you're probably also increasing the width of that excess return distribution because your tracking error will be bigger. I would say that if the strategies are well defined, well designed, you can actually balance the trade-off between those two effects so that to actually achieve very comparable results. That's typically what you see in terms of just the average excess return numbers we see for these portfolios versus the tracking error we see. But I would say there's still a limit to it, how much you want to concentrate. Right, you can still say, oh, I can find 20 stocks, right? That the smallest, deeper value, highly profitable. Yes, maybe on paper they will have the highest expected return, but it's still not a robust portfolio, and then trading costs will be super high if you have such a tiny opportunity set. So I guess I would say you can achieve comparable results, but you need to design thoughtfully. Yeah.
Interesting. I think that's probably where that discussion in the rational-minded community ended up, that there's a trade-off between concentration and expected returns, and it's really hard to define where that optimal point is.
Mm-hmm.